Using your home loan smartly with the right products can mean that you save a lot of interest in the long run, and also you can still retain control. So we're going to get into some of the basics today. And the key thing to remember though is the interest is calculated on your home loan on the daily balance. What do I mean by that? Well, if you're going along with a home loan here, and let's say it's you put in a big chunk on one day, it means that you start to save interest on that portion straight away, right? So the interest is calculated on the daily balance, and that's important to remember as we get into these products, right? So let's have a look at these products in detail. So basically what you have out there is you have fixed, floating, and revolving, right? So these are kind of your main products. Now fixed, you can fix for length and time, 1 year to 5 years generally. After that fixed rate period, you can fix again, but at the rates at that time. It means that you have stable repayments, you know what they're going to be for a length and time. Floating and revolving don't give you that. They can change anytime. So yeah, something to be aware of. However, obviously if the interest is calculated on the daily balance, then extra repayments are going to be great. However, on a fixed rate home loans, banks tend not to like extra repayments. It can mean that you may pay a break fee, but some fixed rates do allow a little bit of flexibility there. So that's where the revolving credit and the floating home loan comes in. You can make any kind of extra payments at any time, okay? Now, it's all well and good to make extra payments, but what about if you can't? That's where redraw comes in, right? So with a revolving credit limit, you are able to redraw any extra payments you've made. So let's say you're paying $50 extra every week. At the end of the year, you have an emergency and you need $1,000. Well, with the revolving credit home loans, you could draw back out the $1,000 that you've made in additional repayments. Now, there are some slight differences between these products and how they work, apart from these major things. So we're just going to give you a brief overview. Each bank might have a little bit extra in the nuances and how they operate. And there is also an offset home loan, which can be used as well. So how does the revolving credit work? Let's get into that. But before I do, just keep in mind one thing, right? Your home loan can be a mixture of these products, okay? So you can split the home loan up into different products, but you can also, remember, fix it up into different fixed rate terms as well. So you could have half fixed for length and time and half fixed for another length and time as well. So there is real flexibility there. Now, let's have a look at how the revolving credit works. Normally, a lot of people traditionally used to have a separate check account, separate savings account, and a separate home loan, right? With a revolving credit, you can basically park everything inside one home loan, which means that as you go along your daily business, whatever credit funds you have in there will save you interest, as the interest is calculated only on the outstanding balance. The beauty of the revolving credit, as I mentioned earlier, is you can redraw back up to the limit. Now, some banks have a reducing limit, which we can get into a little bit more detail about in a different. Well, you can always contact us if your advisor will be in touch around that as well, obviously. But the other thing to consider is offset home loan. So with offset home loan, you can actually keep the tranches separate, and you can just link them up to transactional accounts, so that every evening the interest is calculated on the sum of those balances. So look, hopefully that makes sense, and I think the key thing to remember is, as advisors, we're here to help, and we're here to review what happens years from now as well. So the key goal here is to retain some control, flexibility, knock out little chunks on a revolving credit or offset home loan or a floating home loan, and then just move more chunks over the years from the fixed onto these pieces as the fixed rates comes up for maturity. So thank you for watching. Hopefully that has been helpful for you.